Alright, Jenna, today we're talking about stockholders' equity, which sounds simple until accounting turns it into 5 buckets, several subclasses, and one category called treasury stock. That is definitely not treasure.
That's fair, Russell, but the big picture is actually manageable. Stockholders' equity is the owner's residual claim on the company's assets after liabilities are subtracted. So if assets are the whole pie and creditors get served first, equity is what belongs to the owners after the creditor's slices are gone.
So equity is the leftovers.
That analogy helps, but it can sound too casual. Equity isn't just some accidental remainder. It is reported in organized categories that tell us where the owner's claim came from and how it changed.
Right. So let's build the map before we start wandering through the forest.
The module gives us 5 major components of stockholders' equity. Capital stock, additional paid-in capital, retained earnings or deficit, accumulated other comprehensive income, and treasury stock.
Capital stock is the legal ownership layer. Additional paid-in capital is basically the extra contributed amount. Retained earnings is accumulated business performance that stayed in the company. Accumulated other comprehensive income is the special holding area for certain items that bypass net income. And treasury stock is the company's own shares that it bought back.
Exactly. And one more point from the overview. When consolidated financial statements are presented, any non-controlling interest is also shown in equity.
Let me try an analogy. Think of total equity as a house with several rooms. Capital stock is the front entrance because that's where owners come in. Additional paid-in capital is the extra furniture they brought. Retained earnings is everything the household accumulated through years of living there. Accumulated other comprehensive income is the attic where certain unusual items are stored. Treasury stock is the homeowner buying back pieces of the house.
The first 4 parts work. Treasury stock breaks the house analogy. You can't really buy back your own living room and keep it in the garage.
Accounting always ruins my architecture.
A better treasury stock analogy is concert tickets. The company originally releases tickets, meaning shares, to the public. Later, the company buys some tickets back. Those tickets still exist, but they're no longer in the hands of outside investors. That distinction will matter a lot.
Good. Let's start with capital stock and legal capital.
Legal capital is the amount that must be retained by the corporation for the protection of creditors. The module explains that the par value or stated value of both preferred and common stock is legal capital and is frequently referred to as capital stock.
And this is one of those rules that feels odd because par value often has almost nothing to do with market value.
Correct. Par value is not the stock's trading price. It is a legal and accounting amount assigned to the shares. Preferred stock generally has a par value. Common stock may be issued with par value, without par value, or as no par stock with a stated value.
So when a question gives you par value, don't treat it like fair value. It's more like the legal label attached to the share.
That's a good way to frame it. Now we need the 3 share count terms: authorized, issued, and outstanding.
The holy trinity of stock count confusion.
Authorized shares are the maximum number of shares the corporation is legally allowed to issue under its charter. Issued shares are shares that have actually been distributed by the corporation. Outstanding shares are issued shares currently held by shareholders outside the corporation.
And treasury stock is the key subtraction.
Yes, outstanding shares equal issued shares minus treasury shares.
Let's use the concert ticket analogy. Authorized tickets are the maximum number the venue is allowed to print. Issued tickets are the tickets that were actually released. Outstanding tickets are the tickets currently held by concert goers. Treasury tickets are the ones the venue bought back.
That analogy works very well. And here's the trap. Treasury shares are still issued, but they are not outstanding.
That sentence deserves to be repeated. Treasury shares are issued, but not outstanding.
And the number of authorized, issued, and outstanding shares must be disclosed.
Now, common stock. This is the basic ownership interest, right?
Yes. Common shareholders bear the ultimate risk of loss and receive the ultimate benefits of success. Their return is not guaranteed. Dividends are paid only if declared. They also have the right to vote. The right to share in assets after creditors and preferred shareholders are satisfied, and possibly preemptive rights.
That preemptive right point is the pass key in the module.
Right. Common shareholders may have preemptive rights to maintain their proportionate ownership if additional common shares are issued, provided those rights are granted in the Articles of Incorporation.
So, suppose I own 10% of a company. The company issues more shares. Without some protection, my voting and ownership percentage could shrink.
Exactly. Preemptive rights may give you the opportunity to buy enough new shares to preserve your 10% interest.
It's like being allowed to add water to your glass before someone dilutes your drink.
The dilution idea works, but remember, the right depends on what the corporate documents provide. It is not automatic in every situation merely because someone owns common stock.
Exception noted. Now, let's talk about book value per common share.
Book value per common share represents the amount common shareholders would receive per share if all assets were sold at their book values and all creditors were paid.
And the formula is common shareholders' equity divided by common shares outstanding.
Yes, but the numerator is where candidates get tripped up. Common shareholders. Equity begins with total stockholders, equity, then subtracts the claims belonging to preferred shareholders.
So, total equity is not automatically common equity.
Correct. The module specifically says to subtract preferred stock outstanding at the greater of call price or par value, and also subtract cumulative preferred dividends in arrears.
Let's slow down there. Greater of call price or par value. Why the greater amount?
Because the goal is to identify the preferred claim that sits ahead of common shareholders. If preferred shareholders are entitled to more than par because of a call feature, that larger amount reduces what is available to common.
And cumulative preferred dividends in arrears also reduce common shareholders' equity for this calculation because those unpaid dividends are ahead of common.
Exactly. Then, divide by common shares outstanding, not issued shares.
Because treasury stock is issued but not outstanding.
There's our first callback.
Now preferred stock. I think students sometimes hear the word preferred and assume it is just common stock with better customer service.
That is definitely not the right model. Preferred stock is an equity security with specific preferences and features that common stock does not have. Usually those preferences involve dividends and liquidation.
So, preferred shareholders are generally first in line before common shareholders for declared dividends and for payment in liquidation.
Yes, but preferred shares may vary dramatically depending on the contract. They may be cumulative or non-cumulative, participating or non-participating, convertible, callable, or mandatorily redeemable.
Let's go feature by feature, because this is where the exam likes to stack adjectives until the stock sounds like a legal sandwich.
Start with cumulative preferred stock. If a preferred dividend is not paid in a given year, the unpaid amount accumulates and must be paid before dividends can be paid to common shareholders.
Those accumulated unpaid dividends are called dividends in arrears.
Correct. But here's the exception candidates must hear clearly. Dividends in arrears are not a legal liability until the board declares a dividend.
That feels counterintuitive. The company has to pay them before common gets anything, but they are still not recorded as a liability yet.
Exactly. They are a preference, not a declared obligation. Even though they are not recorded as a liability, they must be disclosed in total and on a per-share basis, either parenthetically on the balance sheet or in the footnotes.
So the obligation is economically important before it is legally payable.
That's a fair way to think about it.
Now, non-cumulative preferred stock.
With non-cumulative preferred stock, dividends not declared in a particular year do not accumulate. Those missed dividends do not become a future claim.
So, cumulative means missed dividends wait in line. Non-cumulative means missed dividends disappear.
Exactly.
Next, participating preferred stock.
Participating preferred shareholders may share with common shareholders in dividends above a specified amount. Full participation means preferred shareholders share fully with common after the initial preference. Partial participation means the additional sharing is limited.
Let me picture this as a buffet. Preferred shareholders get served the designated plate first. Then, if the stock is participating, they may come back and share in the extra food with common shareholders.
That analogy works, as long as you remember the contract determines whether participation is full, partial, or non-existent.
And non-participating preferred stock only gets the stated preference. No second trip to the buffet.
Exactly.
Now the module has a detailed example involving cumulative participating preferred stock. We don't need to grind through the numbers, but the order matters.
Very much. First, pay any preferred dividends in arrears. Second, pay the current preferred dividend. Third, give common shareholders an equivalent current return based on their stock terms. Then allocate any remaining dividend between preferred and common according to the participation arrangement.
So the mental model is catch up preferred. Satisfy current preferred, bring common up to the comparable level, then share the leftovers.
That is an excellent summary of the order.
Convertible preferred stock is more straightforward.
Convertible preferred stock may be exchanged for common stock at the option of the shareholder at a specified conversion rate.
Callable preferred stock is the opposite side of the option.
Right. Callable or redeemable preferred stock may be repurchased by the issuer at a specified price at the issuer's option.
So convertible gives the holder the choice to move into common. Callable gives the issuer the choice to buy the preferred shares back.
Correct. Keep the direction of the option straight.
And now the big exception, mandatorily redeemable preferred stock.
This is important because it is called preferred stock, but the module says mandatorily redeemable preferred stock is issued with a maturity date. The issuer must buy it back on that date. Because that obligation resembles debt, it must be classified as a liability, unless the redemption is required to occur only upon liquidation or termination of the reporting entity.
That is a classic substance over label situation. It says stock, but the unavoidable repayment feature pushes it into liability classification.
Exactly. The name does not control the classification. The terms do.
Now, additional paid-in capital.
Additional paid-in capital is generally contributed capital in excess of par or stated value. But the module emphasizes that APIC can come from several other sources too,
Such as sales of treasury stock at a gain, liquidating dividends, conversion of bonds, and small stock dividends.
Yes, one warning though. When the module says treasury stock sold at a gain, that does not mean an income statement gain. It means a credit within equity.
That distinction is crucial. Treasury stock transactions do not create gains or losses in net income.
We'll come back to that repeatedly.
Let's move to retained earnings.
Retained earnings, or retained deficit, represent accumulated earnings or losses over the corporation's life that have not been paid out as dividends. Retained earnings generally increase with net income and decrease with net loss and declared dividends.
The module's formula also includes prior period adjustments and accounting changes reported retrospectively.
Yes, those items can adjust beginning retained earnings. But retained earnings does not include treasury stock or accumulated other comprehensive income. If the retained earnings balance is negative, it is called a deficit.
That point matters because people sometimes treat total equity like one giant pot. It is not. Retained earnings is one specific bucket.
Exactly.
Now appropriated versus unappropriated retained earnings.
Appropriated retained earnings are designated for a specific purpose, usually to inform shareholders that a portion of retained earnings is not currently available for dividends.
But the appropriation is not cash locked in a vault.
Correct. It is a classification within retained earnings, not a separate asset. The module lists possible reasons, such as bond indentures, inventory price declines, plant expansion, or general contingencies.
And an appropriation cannot be used to absorb costs or losses, and cannot be transferred directly into income.
Right. The accounting entry simply moves an amount from unappropriated retained earnings to appropriated retained earnings. Total retained earnings does not change.
So it's like placing a label on part of the retained earnings balance.
That analogy works. It signals purpose or restriction, but it does not create money.
Next, accumulated other comprehensive income.
Accumulated other comprehensive income is an equity account that includes the cumulative total of other comprehensive income items. The module lists pension adjustments, unrealized gains and losses on available-for-sale debt securities and hedges, and foreign currency translation adjustments.
And the key distinction is that these items are not included in net income when recognized. Instead, they enter comprehensive income through other comprehensive income.
Then their cumulative balance appears in stockholders' equity as accumulated other comprehensive income, shown separately from capital stock, additional paid-in capital, and retained earnings.
Now we arrive at the section that usually causes the most damage: treasury stock.
Treasury stock is the corporation's own stock that was previously issued to shareholders and later reacquired, but not retired.
That last phrase matters: reacquired, but not retired.
Yes. Treasury shares are issued shares, but they are not outstanding. Treasury stockholders are not entitled to vote, receive dividends, or participate in assets upon dissolution.
And treasury stock is not an asset.
Correct. It is a contra equity account. Acquiring treasury stock reduces total stockholders' equity.
This is where people say, but the company bought something. Why isn't it an asset?
Because the company cannot own a claim against itself in the same way it owns a building or an investment in another entity. Treasury shares represent the company's own equity instruments pulled back from outside ownership.
Concert tickets again. When the venue buys back its own tickets, it has not acquired an external resource. It has reduced the tickets held by the public.
Exactly.
The module permits two methods: the cost method and the legal or par value method.
And the methods differ mainly in timing. Under the cost method, the treasury shares are recorded at reacquisition cost. This is the method used by roughly 95% of entities, according to the module.
Under the par value method, the treasury shares are recorded by reducing the capital accounts, as if the shares were effectively removed at the time of reacquisition.
Right, but before we separate the methods, let's state the rule they share. Gains and losses from treasury stock transactions are not reported in the income statement.
Not now, not later, not disguised as other income.
Correct. Any favorable difference generally goes to additional paid-in capital related to treasury stock. Any unfavorable difference reduces that APIC balance first and may reduce retained earnings if the APIC balance is insufficient.
And retained earnings is never increased because treasury stock was reissued below or above some amount.
Exactly. Net income is never affected.
Let's do the cost method conceptually. The company buys back shares. What happens?
Debit treasury stock for the amount paid and credit cash. Under the cost method, no distinction is made at reacquisition between par value and the original amount received. The treasury stock account carries the reacquisition cost.
So the accounting says we paid $20 per share to take these shares out of public hands. Record $20 per share in treasury stock.
Yes.
Then the company reissues some shares above cost.
Cash is debited for the proceeds. Treasury stock is credited for the original reacquisition cost of the shares reissued. The excess proceeds are credited to additional paid-in capital from treasury stock.
And again, not a gain.
Correct.
Now, reissue below cost.
Cash is debited for the lower proceeds. Treasury stock is credited for the original cost. The shortfall first reduces any available balance in additional paid-in capital from treasury stock. If that balance is not enough, the remaining shortfall reduces retained earnings.
This is where the sequence matters. First a pick from treasury stock, then retained earnings.
Exactly. Do not jump directly to retained earnings if the treasury stock APIC balance is available.
And do not use a pick from common stock as though all APIC accounts are interchangeable.
That's another good trap to flag. The module focuses on additional paid-in capital from treasury stock transactions as the first place to absorb the shortfall.
Now the par value method.
Under the par value method, when treasury shares are reacquired, the treasury stock account is recorded at par or stated value. The related capital accounts are adjusted at the reacquisition date.
So, this method recognizes the capital account effects earlier.
Yes, that is the timing distinction. The cost method largely waits until reissuance or retirement to sort out those capital account consequences. The par value method addresses them when the shares are bought back.
Suppose the company originally issued stock above par and later buys it back. Under the par value method, common stock and related APIC tied to those shares are reduced.
Correct. If the reacquisition price exceeds the original issue price, the excess may reduce additional paid-in capital from treasury stock and then retained earnings if needed. If the reacquisition price is below the original issue price, the difference increases additional paid-in capital from treasury stock.
And when the shares are later reissued, the treasury stock account comes off at par value, while any difference between cash received and par goes to a PIK.
Exactly.
The module has an illustration showing that the cost method and par value method can produce the same total stockholders' equity, even though the individual account balances differ.
That is the conceptual takeaway. The economic event is the same. The methods classify the effects differently and recognize them at different times.
It's like two people organizing the same suitcase. One sorts everything immediately by category. The other throws items into a temporary section and sorts them later.
That analogy works. The total luggage is the same, but the internal arrangement differs.
Now retirement of treasury stock.
Retirement means the reacquired shares are permanently removed rather than held for possible reissuance. Once retired, they are no longer issued.
So, treasury stock is issued but not outstanding. Retired stock is not issued and not outstanding.
Correct. Under the cost method, retirement removes the original capital associated with the shares and eliminates the treasury stock balance. Any difference is assigned within equity, potentially involving additional paid-in capital and retained earnings.
Under the par value method, the reacquisition already adjusted the capital accounts, so the later retirement is simpler.
Exactly. Again, the timing of recognition explains the difference.
The module also covers donated stock, which sounds like a bizarre gift.
Donated stock is the corporation's own stock received as a donation from a shareholder. The module says there is no change in total stockholders, equity from the donation itself, but the number of shares outstanding decreases.
And donated shares are recorded at fair market value for both the treasury stock side and the additional paid-in capital side.
Yes. Then, when the donated stock is sold, the entry reflects cash received, removes the donated treasury stock amount, and adjusts additional paid-in capital.
Finally, direct retirement of stock.
A company may choose to retire shares immediately upon repurchase rather than holding them in treasury. The entry is based on the original issuance price, not simply the repurchase price.
If the company pays more to retire the shares than the original issuance amount, the excess reduces additional paid-in capital from retired stock, and then retained earnings if necessary.
And if the company pays less than the original issuance amount, the difference increases additional paid-in capital from retired stock.
Again, no income statement gain or loss.
Correct. These are owner equity transactions.
Let's pull the whole module together, Jenna. What is the mental map the listener should leave with?
First, stockholders. Equity is not one account. It is a group of accounts that explain the owner's claim and where that claim came from. Capital stock reflects legal ownership amounts. Additional paid-in capital reflects contributed amounts beyond those legal capital measures and certain other equity transactions. Retained earnings reflects accumulated earnings kept in the business. Accumulated other comprehensive income stores cumulative OCI items. Treasury stock reduces equity for the company's own reacquired shares.
Second, the share count relationship is foundational. Authorized is the legal maximum. Issued is what the company has released. Outstanding is what outside shareholders currently hold. Treasury shares are issued but not outstanding.
Third, common and preferred stock have different claim structures. Common is the residual ownership interest. Preferred stock has negotiated priorities and features. Cumulative means unpaid dividends carry forward. Non-cumulative means they do not. Participating means preferred may share in excess dividends. Non-participating means the stated preference is the limit. Convertible benefits the holder through an exchange option. Callable benefits the issuer through a repurchase option. Mandatorily redeemable preferred stock is generally a liability because the issuer must repay it at maturity.
Fourth, book value per common share starts with common shareholders' equity, not total equity. Subtract preferred claims, including the greater of call price or par value and cumulative dividends in arrears, then divide by common shares outstanding.
Fifth, treasury stock is contra equity, not an asset. Treasury stock transactions do not create income statement gains or losses. Under the cost method, treasury stock is carried at reacquisition cost. Under the par value method, capital accounts are adjusted at reacquisition. The methods mainly differ in timing and classification.
And when treasury shares are reissued below cost under the cost method, reduce a PIK from treasury stock first, then retained earnings if necessary.
Exactly.
I'll give one last analogy. Picture equity as a scoreboard with separate columns. Contributions go into capital stock and a PIK. Business performance accumulates in retained earnings. Certain special items accumulate in AOC. Treasury stock is a negative column because the company pulled some ownership claims back from the public.
That's useful because it shows why moving an amount between equity accounts is not the same as earning income or incurring a loss. The scoreboard may be rearranged within equity without changing net income.
And that may be the strangest but most important lesson in this module. A transaction can create what looks economically like a gain or loss on reacquired shares, but accounting refuses to run it through the income statement because the company is transacting in its own equity.
Exactly, Russell. When a rule feels odd, ask what relationship accounting is trying to preserve. Here, it is preserving the boundary between operating performance and transactions with owners.
So the exam-ready question is not just, what number do I debit? It is, what kind of event is this?
Is it a contribution from owners? An accumulation of business earnings? An OCI item? A preferred claim? A repurchase of the company's own shares? Once you identify the category, the accounting treatment becomes much easier to predict.
Authorized, issued, outstanding. Common versus preferred. Retained earnings versus a PIK. AOC versus net income. Treasury stock versus retirement. Cost method versus par value method.
Those are the boundaries to know.
And if a problem gives you 6 adjectives before the words preferred stock, stay calm and decode each feature one at a time.
Exactly. Accounting loves long labels, but each label usually answers one specific question: who gets paid first? Whether missed dividends accumulate, whether excess dividends are shared, who controls conversion or redemption, and whether repayment is mandatory.
That is much less terrifying than the legal sandwich.
Slightly less terrifying.
I'll take it.